investing in your 401k, saving for the long term, saving for the future, and trying to do kind of the things that other people do. He just will completely blow that. So Garrett, I'm going to shut my mouth and let you take over, brother. Is that okay?
That's good, man. You see
All
me
right,
okay
dude.
now?
Yeah, we're good. And by the way, if you guys can all click to add him, either pin him to the first screen or change the speaker view so you can see him full screen. I cannot make him full screen for you here, so let's rock and roll. And Garrett, I'm gonna turn it over to you.
All right. So look, let me break down finance really quickly for you to simplify it and hopefully make it just slightly more exciting. Well, that's not hard to do because it's usually a pretty boring topic, but it's a super important topic. I mean, anytime people tell me money's not important, I figure they don't have much of it because when I say something's not important, I'm not going to have a lot of it in my life. There's no reason to feel any level of guilt or shame or frustration or negativity or any of that around money because money is simply a byproduct. It's a byproduct of the value that you create, and dollars follow value. So the more value you create, the more money you're going to make. But making money and keeping money are two very different art forms, right? So I know a lot of entrepreneurs that are great at making money, but as far as keeping that money, they fall victim to Parkinson's law. So Parkinson's law is super simple. The guy's last name was Parkinson's, was doing a little study on time management. He saw if a business owner gave their employees something to do by Friday at 5, they'd start working on it sometime around Friday at 4 or 4:30. So he then took this study into the world of finance and said, okay, if someone has an increase in income, what happens? Well, within 3 to 6 months, their expenses either rose to meet or exceed that increase. That's why we see people making more money now in bigger trouble than they were in the past, because there's a lack of management here. Now, the good news is everything I'm going to teach you to battle Parkinson's law and money, I'm going to begin with the very automated things that are simple, but don't discount them. Even though they're simple, they're elegant. This elegant, allowed simplicity in your life that's going to allow you to be a lot more powerful with your money. And the very first one was written in the 1920s by a guy, George S. Clason, if anyone's read the book, The Richest Man in Babylon. He talked about the simple concept of pay yourself first. So pay yourself first is I want everyone to set up a separate bank account sometime, later on this week. This separate bank account is going to be called your wealth capture account. It could be a checking account, a savings account, or a money market. It doesn't have to earn a lot of interest. It's going to be a simple way for you to not commingle your funds and separate those funds. So if you go to your bank, I want you to ask them if they can set up a sweep relationship, SWEEP, a sweep relationship that every time you make a personal deposit, this is not your business account, this is your personal account. If you make a personal deposit, can they automatically sweep a percentage into a different account? That's your wealth capture account. Now, the first reason the wealth capture account is important is peace of mind fund. I want you to have cash that says you have staying power. You've got liquidity. In the world of finance, liquidity is unfortunately underemphasized, yet it's critically important. There's far too many people that get in cash crunches because they don't have cash on hand, and therefore they end up making bad decisions or chase bad profits or getting themselves into a level of exhaustion. So this peace of mind fund, first and foremost, says you've got money set aside if something unexpected happens. And we're all in store for financial surprises. As a matter of fact, we're all in store for those. We just don't know what they are. But I believe over 90% of those don't have to derail or destroy us with proper preparation. And this is one of those first steps. So wealth capture account, you're putting money aside. Now, the goal in this is to get up to 18% that set aside of personal income. Again, not business income. We're talking personal income. But again, I don't want you to scrimp and save or sacrifice to get there or budget. I'm going to find the money for you. But let's say why 18% really quickly. We need 3% because of tax fluctuations. From 1944 to 1981, the tax rate was above 50%. We now have $27 trillion in debt in the United States alone. I think taxes could go up. So we need to save 3% of the 18% for taxes. Another 3% is for inflation. Our purchasing power gets destroyed over time. Things become more expensive, but they're not necessarily better. It's just part of inflation. And the government says it's 3%. That's obviously pretty low, but we'll go ahead and take that number for now. That's why we're adding these other things. Another 3% is for planned obsolescence. Things in your life break down, you have to replace those things. That's planned obsolescence. So we need to prepare for that. When I moved into the house I'm in right now, we had a Viking dishwasher. That sounded tough, but it's just little Vikings licking the plates, not quite clean. Nothing's ever clean from that, so we had to replace it. That's planned obsolescence, right? Another 3% for technological change. So technological change, and by the way, these numbers apply no matter where you live on these percentages. Inflation might be stated more accurately in one government versus another, but it's 18% no matter where you live. So the next 3% is technological change. There's things that we purchase now that didn't even exist in the past. And there's going to be things that we purchase in the future that don't exist now. And if we don't plan for that, I don't want you guys being the one riding around on rubber tires if everybody else is like the Jetsons in the future floating around. You know, we were way off on that, by the way. We were supposed to have these machines by now, but we don't have them, but it's fine. I don't know what technological change is going to come. I just want you to be prepared for it. Another 3% is for propensity to consume. Let me say that more simply. A luxury once enjoyed becomes a necessity, right? A luxury once enjoyed becomes a necessity. I want you to have a better life in the future, not a lower lifestyle because of these factors. And then another 3% is what we're going to be calling your guilt-free spending, value-based spending, living wealthy account. So when you go to the bank, I actually want you to set up two different accounts, not just one. The other account's going to be your living wealthy account, because 1/6 of this money you're saving is going to go in an account that you're going to use for whatever you want to use it for, as long as it's not something destructive in your life. It's a reminder that you're doing things along the way that are smart and intelligent in your finances, and you should be rewarded for that. Budgeting is actually, I wrote a book called Budgeting Sucks, because it totally sucks, because it puts people in a reductionist mindset, restriction, elimination. It's a very limited game. Instead, the game of value creation is a game of expansion. No one shrinks their way to wealth. And so, yes, we want to start doing automatic preparation where you're automatically saving money. And then I'm going to get into where we find these funds here pretty shortly. But I want this to be something you don't have to think about or effort towards. And there's not anything really mystical or magical in the world of finance, but the closest thing, as non-sexy as it is paying yourself first, because you'll find the rest of the funds, especially because we're going to dive into that right now. All right, so let's talk about these 4 I's to efficiency. Now, I know we got people, you know, outside the United States, so I'm still calling it the 4 I's. The first one stands for the IRS, but it could be the Canada Revenue System or whatever it is. But I'm going to give you very practical advice here to put money in your pocket. I'm going to give you a framework around this. Might be a little bit fast and furious, but here's the good news. You don't have to read thousands of pages of tax code. I'm going to give you something that will allow you to operate with your brain in the entrepreneurial world to navigate the very analytical, like technical world of tax. So this will be the most exciting tax talk you've ever had. That's my prediction. Now, okay, the bar is really low on that, but I still think it'll be pretty good. All right, so I want you to draw 3 vertical lines so you end up with 3 buckets, or 2 lines so you end up with 3 buckets. In the first bucket, I want you to write at the top team, and the second one deductions, and the third one reclassification. So we've got 3 buckets here: team, deductions, and reclassification. I'm going to give you my 3x5 strategy here. So the first thing on team is you want to get someone that gets you the data on time, right? I don't know how many of you are spending time in your books and if you really enjoy that, but there's a lot of part-time bookkeepers that you could hire. There's full-time, depending on the size of your business. There's controllers or CFOs. But if you don't get timely data, you will overpay the government. We've seen in 2011, 93% of people that we surveyed, which was looking in detail at their taxes, 117, 107 had overpaid taxes. We started to do more research after the 2017 tax changes. And what we found is it was closer to like 98+%. It was almost everyone was overpaying taxes. So timely data is going to be the big thing to help you not overpay tax. The second person on the team is going to be a tax strategist. Now, this may not be a CPA because some CPAs are more historians than they are strategists. They tell you, here's what you earned, here's what you have to pay. That's a historian. That's not what we're looking for. We're looking for someone who can proactively help you navigate tax deductions. That's the primary purpose I want with the tax strategist. And I'm going to give you some more insight around that here in a minute. But the third person on your team is an attorney. Now, if you're doing, if you're doing multiple 7 figures of revenue, that's a tax attorney. If you haven't cracked $1 million of revenue, that's a corporate attorney. Just the dealing with the level of complexity and also the price of the tax attorney is going to be more expensive typically. But the attorney is going to be really responsible for that third bucket, which is reclassification, which I'll go over here pretty soon. Now, if any of you own the salons that you're in, if you own the commercial property, you might have a 4th person on your team. And that 4th person is an engineer. That engineer is a cost segregation engineer that can come in and do a study on your commercial property to see if you can accelerate your depreciation for tax purposes. And many times that could double the savings that someone would have on their real estate. So a cost segregation engineer. So that's the team. Second bucket is the deductions. Every time you spend money, I want you to do 2 things. Number 1, ask the question, can this relate to my business? Can this relate to my business? And then the second one is I just want you to document it. Now, when you document it, it may not totally relate to your business. You're going to find this out when you do what I would recommend, quarterly calls with the tax team, okay? Quarterly calls, they might be 20 minutes, definitely no longer than an hour. Nobody has to be on those calls longer than an hour. That's a special torture for someone, I guess, if you want to be on with tax conversations longer than that. But like here's examples. When I flew to Italy a couple years ago, back when we could fly to Italy, you know, I wanted to write off part of the trip. My accounting team, when we did our quarterly call, laughed at me, and I said, "Wait, I'm gonna do my corporate compliance meetings there because I think better in Italy than I do in Utah." And they're like, "Oh yeah, that's a good point. You do get corporate compliance, and you get to, you know, write the part of that off." I'm like, "Oh, I'm going to do a one-day mastermind. I'm there for 2 months. I'm going to invite some of my clients. I'm going to go film where my great-grandfather's from and put it in an origin video." By the end of the call, 55% of my 63-day trip was a write-off, right? So when you're on these calls with your tax team, your job is to be entrepreneurial and brainstorm and think creatively. Their job is to keep you within the law, but it's a brainstorming session. You're not talking to the IRS. You're not going to do all the strategies that you come up with. But that's an example. I write off my clothes, which a lot of people say you can't do, and they're right. Technically, most people can't write off their clothes because they're not a production company. But when my accountant showed me the law that I couldn't write off my clothes, I said, "Well, how does Hollywood get away with it? They've got to be able to write off the stuff that they're buying." He goes, "Well, they're a production company." I'm like, "Well, great. I have 2 video studios. I'm doing production stuff all the time. Why couldn't we buy stuff and call it?" And guess what? We could, because of something called reclassification. But let me just give you a couple strategies really quickly here on the deduction side of things. One strategy is, if you don't know that you can pay your kids, you can pay them $12,200 a year in the United States, and that would be tax deductible to your business and tax free for them if they're under the age of 18. So that's something that's considered. By the way, a modeling fee is standard at $2,500 for a salon or for a website. So that's what you could pay them, just for something that would take very little time whatsoever. The other thing is, I want everybody to know about the Augusta rule. The Augusta rule is you can rent your home out to your business, or really to anyone for that matter, for 14 days a year. That is tax-free income if you just Airbnb'd your home to someone else. But let's say you used it for a team retreat, or you used it for filming something, or whatever that might be. You could actually rent that out to your business. Your business writes that off as a tax deduction, but you don't claim that as personal income. That's called the Augusta rule. I could explain more later if you want to know why it's called that. But the reality is, I'm looking for ways that you can maximize your tax deductions. The ways you're going to do that is meet quarterly with your tax team, have proactive conversations, you know, capture everything that you think could relate to the business and have a conversation around it. Sometimes you can actually, you know, write off part of the things. Like I have my podcast studios up at my cabin, and we have guests on it every now and again. And so I bought a Can-Am, which is like a turbocharged Batmobile looking go-kart thing, right? But I can write off half of it because I have it in the intro of my podcast, and I have guests that are coming and they sign waivers and that kind of stuff because it's a Wealth Labs production. So these are the things that you can start doing as you have these conversations. So let's move to the third category, which is reclassification. So first category is the team. You want a bookkeeper, controller, or CFO, depending on your size, a tax strategist, and an attorney. If you own your own building, you might look at getting an engineer. The second thing is the deductions. Number one, every time you spend money, how does it relate to your business, or could you relate it to your business? And number two, document that. I keep my documentation very rudimentary. So rudimentary, it's printing out credit card statements and writing next to what the thing is so my controller can actually put it in a more organized fashion. But I now have full documentation, never worried about anything in an audit. Third category is the big one, though, is reclassification. 4 ways to reclassify. Number one, can you turn your ordinary income into capital gains? So ordinary income can be as high as 37.5%. Capital gains can be 0, 15, or 20%. You know, let's just say that you're in the United States doing business internationally. You can set up an international sales corporation if you're selling hair products or instructional videos, and that would be capital gains instead of ordinary income, because you're just bringing the money back to the U.S. and they're trying to get that to happen. That's one example. I'll go to the next thing. How do you take active income and make it passive? So active income is anytime you're like a W-2. When you're taking your W-2, you're paying self-employment tax. That's up to 15.3%. But let's say that you take a reasonable salary, which is what would you pay someone else to do, you know, hair or you know, be chairside essentially. And then you would pay yourself that reasonable salary, not what you're worth, but what you would pay someone else. And then you can take the rest in distributions. Those distributions avoid self-employment tax. So they'll save you a minimum of 3.2% and a maximum of 15.3%, depending on how much income's coming through there. But all you're doing is writing 2 checks instead of 1 and reclassifying that income. The third type of income is tax-free income, which if you're ever going to sell your business, knowing your tax-free options now are critical. For example, charitable remainder trusts are something to know about, where you can actually donate a capital gain asset like a building, a business, or a highly appreciated stock to a 501c3. You get a tax deduction for that donation. It's partial deduction, not full deduction. And when you sell that asset or that business, there's no tax on it. And you're the first beneficiary of the trust. You could take an income between 5 and 50% for the rest of your life, depending on the underlying performance of the assets. And when you die, the charity is supposed to keep at least 10%. So you cut out the government, you end up with 20 to 30 to 40% more cash flow because you don't have to pay tax on that sell. And, you know, this is me fire hosing. I'll give you, there's plenty of resources and everything. I'm planting seeds here. We don't have to know all the details of this. I just need you to know this. You've got to know your business exit before it's time to exit. If you wait too long, you might pay way too much in tax. There's something called a 1202, for example, that if you're a C corporation, been around for at least 5 years, but not before sometime in the 1980s, there's up to $10 million of sell tax-free of a corporation. So these are just important things to know. CRTs, charitable remainder trust, 1202, or CAPS trust, CAPS trust. Those are just some business exits. Just I want to plant the seeds and get you percolating. And then the fourth thing here on reclassification, the first one was ordinary income to capital gain. The second is active to passive. Third is tax-free. And fourth is tax arbitrage. Sounds super fancy. All it means is I don't want you guys going out there spending $1 to save 37 cents. I had this consultant client that started working with us in November. And by December, he's in panic because he's gathering information from his accountant. His accountant says, hey, you owe $242,000 more in tax this year than last year. Great job, good work. But he's like panicked. So he calls me, he's like, what should I buy? This is December. I'm like, what would you buy if you didn't get this news? He goes, nothing. I'm like, then we're not going to buy anything. We're going to find out strategy first. There is some time. So because the reason that he had this big tax bill is he did a big event and signed up a bunch of clients as a consultant that he wouldn't start doing the services till the next year. So we just moved from a cash basis to accrual basis, which meant he didn't have to pay the $242,000 of tax that year. We had an extra 12, 13 months because it wasn't until the services were rendered. Then we could do these other strategies. It turns out he paid $3,000 in tax, not $242,000, because we just go through and look at the strategies we're talking about here. So strategies that we looked at for him that I want you to be aware of is R&D credits. If you've built a website, if you've modified an app, if you've modified a CRM, or anything in technology and did that in the United States, there's credits for that. You can go back and get previous credits that were missed. Or if you're not familiar with Section 199A, that is a game changer in how you pay yourself and get what's known as a pass-through deduction and lower your taxes. We've talked about reclassification here, but the fourth one is the tax arbitrage, which is I don't like people to spend $1 to save 37 cents because you still lose money. If you're going to spend $1, tax arbitrage is you better get more than $1 back. 2 examples here. I bought a bunch of artwork. There's some over on that wall from an art dealer that got me with a specific artist that I bought a massive collection, and I agreed that I wasn't going to sell it on the open market because I bought a big collection. I got it at a deep discount. After owning it for 3 years, I could donate it to museums, and I got back $2 in tax savings for every $1 I spent on the art. I did that. I even did that this year again. So that's something that's an example of tax arbitrage. Or let's say that you're looking for a salon that you're going to buy, and it's in a historical area or historic district. There's things called historic easements that if you agree not to tear that building down, but you preserve the aesthetic of it, which a lot of times has a coolness to it, you get major tax credits, which can help offset the cost of the building. So those are tax arbitrage. So look, let me give you this review then. Every 3 months, I want you meeting with your tax team. Could be 20 minutes or an hour. I want you to brainstorm, right? I want you to then every 3 years, look back to see if you've overpaid tax. You can amend your returns if you look back. And if you've overpaid, that amendment can get you money back in your pocket. I've amended twice in my life. Once I had some business partners that died. I didn't stay proactive. I just had, stuff that I overpaid because we didn't look at all my deductions. Another time was this R&D credits that I was telling you about. I was able to go back and get $93,000 back from the government. And by the way, it's not setting up any red flags or chaos or craziness, because they're the ones that agreed to send me the check. I proposed it. They go, oh yeah, I see why that's the case from the study. Okay, so there's tax. Any questions on that? I see there's maybe.
Okay, hold on. I wanna just take 2 seconds here and just ask you guys to type in the chat what's been your biggest takeaway so far. I promised you this was gonna be amazing. Garrett, bro, I have like 8 pages of notes over here as you were just fire hosing stuff. Like I was like, what's that called? And how does that work? And oh my God, like, dude, I feel the same way I did the last time you opened your mouth and just hosed information on people. And I just want to tell you guys, I already told Garrett, like I seeded this early. I think we're gonna have a long-term relationship. I already proposed to him basically and said, will you be my special somebody who helps all these people save money on taxes? So anyway, and again, Garrett's not a CPA, but I love what you said, Garrett, about the strategy of like sitting with your CPA, because you're right. Your CPA will be like, no, you can't write this stuff off, but you've got to brainstorm the ideas and say, well, look, how can I write this off? What are ways that we can get creative together and make this happen? As opposed to them just saying no, but you kind of know that those things are available. And I love that you kind of have these access portals to ideas that can be there. So let's take a look. And if you guys have any questions, ask them in the chat. Of course, this is recorded. You can go back and watch it because Garrett goes almost as fast as I do, for crying out loud, maybe even faster. But yeah, man, let's roll through the chat and just see. Paying your kids, great stuff. Yeah, I want a full day for sure. My hand is cramping. Gonna need a new CPA. Salary plus distributions. I feel great. On the right track. Yep. Thanks for. I have questions on 2 things. Yeah. So Ron, type in your questions, or maybe I can just bring you out. You can just unmute and say that. Ashley says he talks faster than you. I love that. That doesn't happen very often. This conversation focused on personal business. Oh, Greg said, is this conversation focused on personal or business taxes or both? You want to answer that, Garrett?
Definitely both. I mean, there's a lot more opportunity when you're a business owner to maximize tax deductions, but I'm looking at all taxes together to make sure that like we've looked at every single possible thing. But yeah, there's definitely a lot more business strategies than there is personal strategies. But,
well, I mean, you just have so many more opportunities when you're a corporation. You get taxed differently. I mean, there's a lot of different opportunities here when you have a business. Joanne said on here, she said, I didn't realize I could possibly write off half of something. I always looked at it like, could I just write off that trip to Italy, yes or no, as opposed to writing off 50% like you were talking about. That's extraordinary.
Yeah, we're supposed to do corporate compliance meetings every year. I always find great locations to do those compliance meetings, right? So it helps write off travel.
Yep. Chris said the R&D deduction for rebuilding websites. Judy said a new home to host things in. CPA versus CFO, affordability, etc. Is that your question, Gio? Let's do this. Ron, can you unmute, brother, and ask your question here? Ron and Judy, Ron? Let's see. Can you unmute, Ron?
There, can you hear me?
Yeah, we got you, man.
Okay. All right. Well, first off, thank you very, 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 very much, Jason, for bringing him in. You got me feeling so good because I was checking off things. But I do have a couple questions. How do you feel about IE as an example? This last quarter, because of the year we pay quarterly, just like you were talking about. We had over 100,000 in tax credit. I told them let it ride because I watched my family when I was young lose everything because not paying taxes. Imagine that. My dad was a hairdresser, but I felt like let it ride. I'd rather them owe me than me owe them. And we hurt this year because of the virus. And that's how I earned so much of a tax credit. How do you feel about that?
I have a recommendation. I don't like to give the government interest-free loans. They never are interest-free to us, but we are to them. And so there's something called net operating loss. So net operating loss is normally you can only take 80%. So if you have heavy operational expenses some years, maybe you invested in infrastructure or things like that, you're capped at what you can write that off, and then you still have to pay tax. Well, because of the CARES Act and everything that happened with COVID, you can now go way back to 2015. And if you've had years where you had really good gains, you can take years where you had losses and you can actually mix and match the years and get that money back. So I would actually look back and go, did you have really profitable years that you could write some of these things off against and actually get that money coming to you now?
And go back and
I've been
pull
doing
that
this
old money, dude. That's so
Yeah.
good.
I've been doing this for 21 years. I don't do anything that's that would be a concern from, you know, tax evasion or tax fraud or any of that kind of stuff. I don't do anything offshore. But I do fully use everything within the law that they give without concern, because I know that it's there. So, you know, we haven't had issues where a lot of firms do really aggressive things to get tax advantages. I'm just like, no, I'm not willing to do that, because you don't want to have to go back, especially if you take a tax deduction that's greater than 20% of your deductions and it gets disallowed, you have a 25% penalty. So I would be especially careful about that. But I'm also not afraid of the IRS. If they're the ones that give us the playbook and we play by those rules, no reason to be concerned about that. The way that you get in trouble in the United States is not reporting income. That's the number one way that the IRS gets frustrated. In Italy, if you report your income, there's something wrong with you. Why are you not using this art form of pretending you didn't have income come in as a national pastime? But you know, that's kind of the thing. I don't know how it worked in Canada with the new laws, but you could check in and see if those are there as well for the Canadians on here. But
by the way, I just want to, Garrett, I just want to say, if you can hear me, man, I just want to say one thing. Just so you guys know, for my Canadian homies, we've got another guy who we're going to bring in for you guys from Canada, that's a good friend of mine who will be able to vet some of this knowledge with. We're going to have him on coming up in the next couple months as well. So just be prepared. Don't freak out. I know you Canadians are always like, but is that for me? I will get you
Framework's
the pieces
the
that
framework.
are. We'll frame it. Yeah, and by the way,
I used this framework with a Canadian and his accounting team. All I did was give him the framework. He saved $100,000. I mean, you know, like, it's different nuances from country to country, but the framework still applies.
Okay,
Correct.
and Garrett, I keep getting conflicting. We have 3 homes to do what you were talking about, but I keep getting conflicting now. We can only use 1 home for, say, a tax purpose or something, not the other. How does that work, or is that a whole different? Because you had said something where you're writing off different parts. Do we need to shoot video from both of the other rentals, or what do we do?
Well, I mean, I've got multiple properties that I write off because I have multiple companies. This whole Augusta rule is very unclear as whether you can use that for multiple properties. I'm testing it right now, leading the charge to see what will happen, you know, if I get audited, but it's not clear. Nobody can give me a clear answer on that. But to have multiple offices that you're writing off a percentage of a home, that's fine. But to write off the Augusta rule, where you're actually renting that property without the income that comes in from your business renting it, that's unknown. I wish I could give you a better answer on that one.
But that's a great example, Ron, because you have multiple companies. As long as you split them up within those multiple, you'll be able to get that sorted.
That's true. Never thought that way. Yeah.
No, but for real, right? I mean, you have like each one of your schools and academies should all be separate technically, and then it would allow you to write that off, at least according to what I'm hearing. So that's good.
Yeah.
Let's see if I can get another question in here. Gio, thanks, Ron. Gio had a question you wanted to ask. Gio, I'd like to give you the shot to ask your question. Gio, you want to unmute yourself, man?
Yep. Thanks, Chase. Gary, just real quick. Obviously, most of us haven't been instructed or taught this avenue, and we just have an accountant and whatnot. But what's the difference between CPAs, CFOs, price, affordabilities, and so on for somebody that's in the starting stage?
Yeah, a CFO is probably unnecessary in a starting stage. A CFO is primarily going to be building out performas and looking at margins and looking at how you're allocating funds within your business. So they're going to be really good if you're going to have a lot of locations and they're going to have a lot of scalability.
What size would you say, Garrett? What size business for a CFO?
I've seen people that have, you know, $1 million in revenue get a fractional CFO, so that they have someone that's part-time for them that does the services rather than having a full-time person. Because it just depends on the scalability to me as whether you want to have a CFO. Like, you know, if you're going to have multiple locations, you're going to have uniform practices, you're having, you know, centralized finances, CFO is going to be great. If you have a smaller business, a controller is fine, which might do payroll and, you know, and just have all your finances in order. But for others, just a basic bookkeeper that can simply give them timely data with basic payroll services would be suffice. It all depends on complexity more than size. You know, any business
Got it.
over 5 million that doesn't have a CFO would be concerning to me. A business under $1 million might feel like that's taking a bazooka to just a tiny little, you know, target. So
yeah.
But
Awesome.
the tax strategist, most CFOs are not tax strategists. I mean, you'll have some that maybe have that background, but they're more looking at the financial picture of the business and where the investments are going to go inside of the business and what services make sense and giving you really good data that way. Where a tax strategist is specifically looking at how do we pay the least amount of tax possible, and they're typically going to collaborate with the CFO. But you know,
good.
Yeah, most businesses don't need a CFO that are you know, especially if they haven't even hit $1 million of revenue. I don't see any reason for it.
Awesome. Garrett, Lynette asked on here, is there anything else regarding the CARES Act that they could know or that would be helpful for them specifically?
You can take $100,000 out of your retirement plan without penalty right now. You can spread that tax out over 3 years if you want. The net operating loss is probably one of the biggest things that came across with the CARES Act overall. You know, if you got PPP money, that's forgivable if it's done properly. Yeah, I'm glad that those days of me talking about that every day are over. That was the worst part of the coronavirus for me, was like talking about that every day.
Garrett, what would you say that in your mind might be some ways as these salon owners, I mean, you kind of understand at least, you know, the basics of how a salon functions. What would you think might be some lost opportunities for them to pay attention to as salon owners that they might not be writing things off that they could be, or ways that they need to maybe at least have a more aggressive conversation with their CPA to see and investigate and see if there's more write-offs for them?
I mean, I think that R&D, because almost everybody's done something to a site, you know, that
was a big one.
Yeah, that's going to be a big one to look at. How you're paying yourself, salary versus distributions. That's going to be another big one. Like write-offs, think about how I have like this production company and therefore I can write off a lot of my clothes I wasn't able to write off before. Think of like the things that you're purchasing in everyday life that could actually be something that's helpful to your customers or knowledge or anything like that. Like we have a lot of people in the health space that they get a write-off pretty much all their food because they're constantly building recipe books or teaching, you know, nutrition stuff. And so, you know, they could even write off their Lululemon clothes, but I can't do that because I'm just lounging around, not doing anything when I'm in them. So you just gotta,
that's a little different.
Yeah.
Yeah. So, Rachel asked on here, she said, if we operate like a Shopify page or they build out that website, like and develop, especially during coronavirus, a lot of them had to create online stores and things like that. You're saying a lot of that development could potentially be a R&D credit. Is that what you're saying?
Doesn't matter whether or not you like improved an existing platform or started your own from scratch. It's about, did you actually make investment of time and money in anything around technology?
So your time, so it's not just like, are you paying $50 a month for Shopify? It could be the expense that you should have paid yourself or the other people that you paid or a contract that you hired or something like that to build out that whole section.
And even if you paid those contractors, you're still getting credits for using United States contractors. You're getting credits for the time that you spent as well in doing that. So yeah, R&D.
Yeah. And R&D is research and development. Yeah, that was that is what R&D stands for, research and development as you go forward. Yeah, Dana, you wanted to ask a big question. Go for it. Is that what you meant? You have a big question to ask?
Yeah, so I have a question. So like, when you're talking about like time and money, so like Greg's an IT guy, my husband, and he's on this call, and he does we have the world's best server at our salon, and he does all kinds of crazy stuff, but we don't pay him. But for tax purposes, we could have paid him any, you know, whatever, and be writing off his time and his skills, even though we're not technically paying him, correct?
Well,
R&D, is that what you're saying? Because I mean,
if you use R&D credits, yes, you couldn't do it in any other way, but you could do it with R&D credits for sure. I mean, depending on how much time and, you know, all that kind of stuff and what was being built.
Yeah, I mean, and what I'm hearing you say is that it would be more, and I'm trying to catch if I get this 100%, Garrett, is that it's more like instead of Dana taking out a profit distribution check, which she may do, there may be a better way that has less tax that comes out as R&D credit if she takes that income out through that payment as opposed to a distribution.
You don't even have to take it out as income. It's just simply credits for the time. So
I see what you're saying.
It doesn't matter whether they're a 1099 or W-2 employee or any of that kind of stuff.
That's what I wanted to know. So yeah, we can use the credits even though he technically doesn't get paid.
And yeah, I mean, I definitely think that you can, because you could have him, you know, even if he's like a 1% owner of the business, then it's an ownership thing, you know. There's a reason that he's contributing the time and all that kind of stuff.
Great question. Tina's got a question up here too. Tina Leno. She said, when you have shareholders, so a lot of times, just Garrett, to give you some context, a lot of times these salon owners will have a business, then they'll bring on somebody in leadership, and they'll start buying into the company over time for a smaller percentage, and then eventually take over the whole company. Question around this is, when they buy into the company, are there any things they need to know about their taxes, or is there a way that saves them any taxes as they buy in as shareholders?
So there's a couple options that you could do here. And one, I'd say you got to be a certain size of business, like 25 employees or something, called an ESOP, an employee stock option program, where the banks will actually finance the buy-in for them, and there won't be tax paid on that transaction because it's inside of a special employee stock option program. So that would be one way that you could do it with some tax benefits. You know, the other way is just do like a carve out where you have a certain percentage of your company that's actually stock that you could issue to other people. And I've done that as a stock option program as well. There isn't like major tax advantages to that one like there is the ESOP though.
Awesome. Super helpful. Let's see, there's another one. Can you trade work for ownership in the company is another question. Like, can somebody work to earn a 1% ownership in the company? And
that happens all the time. Yeah, that's a pretty normal practice. Yeah.
Got it. Question is, how do you document this R&D so that it's accounted for when you talk to your CPA? Says Lindsay.
Well, if you do it retroactively and try to do it on your own, you'll just hate me because it's the worst process. The first time I learned about it and tried to do it, I'm in these spreadsheets, we're interviewing all of our employees. So we actually just use a firm. I'm happy to, you know, connect you guys to the guy that I use, and they actually have a software program, and they just ask you questions for like 15 minutes, and then they use the software program to tell them what your basic, you know, what your basics might be, and then they look at your overall financials and stuff. So they do the majority of the work that way, rather than when you try to do it on your own. Like it's super painful. So
yeah, if you have that, either you can share it now if you want, either in the chat, or you can share it with me later and I can post it to the group, whatever's easier for you, Garrett. But I'm sure there's lots of people that would love to have access to that for sure, man. That'd be a great one. Myself included.
I'll get it to you after because I just have his cell phone here.
Okay, cool, man. Well, yeah, that's fine. We can chat. Chris has a question. I think a lot of other people may as well. Chris Barron, good to see you on, brother. By the way, Chris Barron said we have an accountant it's a historian. How do you find one that will help you with tax strategy? And Garrett, you and I were just talking about this last week, man. I've had my 4th interview with the tax historian. So how do you go about finding somebody else who can do more strategy?
Wealthfactory.com/private. We have our so, like that's a
I mean that's what I called you for, man. I was like, let's have the chat and talk to some of your people, right?
Yeah, I mean, I have basic questions that we give people that want to go find them on their own. It's not an easy process. Our process is we send them books. They read my books. We look at, they've usually done something for one of our clients. That's how we met them. And then we have a 42 question application process. It's a 9 to 10 month process of vetting. They look at, you know, different clients of ours financials. So it's really tough to find the right accounting people. And here's why. If they're really good, they usually get bought out by like a family office, which is like a uber wealthy family that just has them working for them, right? Like the Rockefellers kind of invented that. Or they might close their practice where they go, okay, I've got all the clients that I want. I don't want any more, which we've had that happen with some of the accounting firms that we use. Then there's others that just try to keep growing their business and they're not good at growing a business, so that you just don't get, you know, responded to very well. They're just filing the taxes to get paid. So it's just a consistent issue because really, really good people get into high demand, and then they eventually either stop taking new people or they stop being as good as they used to be. So we're consistently looking for those firms and trying to help people out with that.
Yeah, and by the way, I just dropped the wealthfactory.com/private in there. I mean, look, Garrett's a rock star. I wouldn't have brought him in if I didn't think he was spectacular at what he does. We've been having some chats, and like I said, I'm going to be working to, like you guys can clearly, obviously work directly with him, but I also want to let you know we're going to bring him in on a more regular basis, so you guys have some of this. We've realized that as an academy, this is a piece of advice that we need to be giving at a deeper level, and so we're working on some strategy with Garrett to have him come in and regularly give some advice to you guys. So just be aware. That's something that we are working towards. I know some of you guys are all over it, and you're like, cool, Garrett, I'm going to be the first person on the phone with you tomorrow. But I just want you guys to be aware that that stuff is pretty quick. How many years back could you redeem previous benefits as the ones you mentioned? Yeah, like can you go backwards? I think somebody said 2015. Is that accurate?
You go back to 3 years typically, but because of the CARES Act and net operating loss, there are some things you can go back to 2015 for right now. That's not normal. That's just kind of in today's environment. But normally it's 3 years. Right now, you can go back a little bit further if you've had some operating losses in certain years that you want to mismatch to years where you had more profit.
Awesome. Garrett, I just want to throw out for you. I know, Killing Sacred Cows is the book that I kind of know you best for. But can you talk about just some of the books that you've put out and what resources they would be so people can kind of know and hear a little bit about that for a second?
Yeah, and I mean, we can give a couple books away for free if you want on that.
Yeah, dude, that would be awesome.
Yeah, we've got I think it's wealthfactory.com/megakit, MEGAKIT. You can get What Would Rockefellers Do or What Would Billionaires Do, depending on what the title is. It's the same book, but we had the Rockefeller family reach out to us. Had no problem with the content in the book, but didn't like us using their name when we were using ads online. Little problems. So What Would Rockefellers Do is a really good book about like how to start small and start really capturing wealth, and then use some of the tools that the highly affluent have used. And so it's a very strategic book. And then I wrote the book Budgeting Sucks that I mentioned. I think budgetingsucks.com, which is very much in alignment with the topics we were talking about today. How to keep way more of the money you make without having to cut back and create an automated infrastructure. I wrote a book, 5-Day Weekend. And I'm writing a book right now. It's called What's Your Number? It's been in a long time in the works. I'm planning on having it done by the end of this month as far as into the next round of edits. And then I wrote The Money Tree, Portal to Genius. So I've written a lot of books. A lot of those books were written because I had co-authors. The book I'm working on now, I'm the author. So it's taking a lot longer than some of these books where I have co-authors. But
little problems, right?
That's what I've done. Yeah.
Dude, super good. By the way, the link for all those books, and I think Garrett, you've got the ebook version of them available at that website, wealthfactory.com/megakit. That's the one where they can actually download those books for free, correct?
Yep.
Dude,
totally.
super good. I mean, how many of you guys have noticed, by the way, Garrett is not only a super giver, but literally a wealth of information. Give me a hand up on the screen if that's the case. Clearly, Garrett is a sharp fella. I mean, that's why I want him to be coming here and hanging out. Let's see. I think there's a couple more questions up here. So we've got about 5 more minutes. If you guys have questions, go ahead and put them in the chat. Mandy said, if you paid yourself more W-2 wages instead of letting it flow through your profit distribution in past years, can you go back and change that?
No, but you could look at Section 199A moving forward on how you handle your wages versus your profit distributions. 199A would be really important for that.
Got it. So I can go back and do some of that.
I don't know how you go back, but you have before the end of this year to maybe make some changes. But to go back previous years, there's just certain things that when you miss credits, you can go back, or when you make errors, you can go back. But if you just missed things or didn't do it a certain way, sometimes there's not much you can do about that.
Yeah, and just to clarify too, my understanding of maybe what your question is here too, Mandy, is that if you needed to pay yourself a certain wage for W-2 and you're like, oh, it'd be cheaper if I took it as distribution, you still have to pay yourself a fair wage as a part of your W-2. So you can't just like pay yourself $10 as a W-2 and then take it all as distributions. You still have to pay yourself a reasonable wage. So just be aware, even if you paid yourself more, because I've been dealing with that too. Like I had my quote reasonable wage from 12 years ago is very different than reasonable wage today. We just had to make that adjustment this year because it's been not keeping up with the Joneses, if you will. Let's see. There's some questions on here. Danielle, who's out of Canada, says, we continue to find personal expenses. As we continue to find personal expenses you can classify as business expenses, how do we treat this for shareholders? Yeah, like if you want to write off things through the company and you're still trying to show profit, how do you write off things with shareholders inside the company?
It just depends on what your operating agreement says in your entity or what your understanding is for your shareholders. Most of the time, businesses can just have whatever expenses they want. And sometimes shareholders get gross versus net to protect them against, things being overexpensed, like people buying vehicles or people buying second homes in the business can hurt a shareholder. But it just depends on what their expectations are, how you lay that out within your operating document. So
yeah. And I would just say, even through our company too, Doug and I have it set up in a way that like we just pay attention to anything that gets classified. Like if it's a personal tax savings, that would qualify as income to me out of the company, so, or income to Doug. So you can still take write-offs and still count that as income, just to count it a different way for tax purposes.